Second presentation is a duo presentation, and as I said in my introduction already, CERA is a global association. So from someone working in Germany, we are now jumping to two people who have their domain in Australia. I want to introduce James Aclis, a qualified fellow of the Institute of Australian Actuaries and the CERA. More than 12 years of experience, general insurance. He worked in New Zealand, in the UK, in Saudi Arabia, experienced in valuations and modeling in analytics and risks. With decades of public speaking and communication experience, he believes that communication is the neglected key to success. James is also co-author of the 2023 KPMG General Insurance Industry ICAAP Survey, co-author of the 2024 General Insurance Industry Recovery Plan Survey, and the 2025 KPMG Private Health Insurance ICAAP and Recovery Plan. James has also advised numerous non-insurers in their risk management approach to and management of insurance and considering of mutual, captive and other alternative risk solutions. He's not alone. They give a duo presentation. He's together with Augustine Sidik, manager of KPMG in Australia, qualified actuary and a CERA with more than 14 years of experience in general insurance, based in Sydney. Augustine has been extensively involved in various reviews and developments of general insurers' internal capital adequacy assessment process since the requirement was first introduced by the APRA in 2013. APRA is the Australian supervisor, for people who are not aware of that. She has also supported similar reviews of ORSA for general insurance clients across Asia. Also co-author of the triennial KPMG General Insurance Industry ICAAP Survey since 2014, and with the 2023 survey seeing a participation rate of over 75% of Australian general insurance industry. So together they are trying to explain to us that capital management can be good or not so good, and what are the risks of this process. James and Augustine, the floor is yours.
Thank you very much, Ron, and welcome all, whether it's a good evening, good afternoon, or morning from wherever you're dialing in. Thank you for tuning in to our presentation. My name is James. I have here with me my colleague Augustine, and we will be talking about the good and not so good capital management, the risks of a poor process. So really, our presentation is focused on any process, any risk management process. But what we're trying to do is use capital management as a key example. And the reason is because we have quite a bit of experience in that space. We've done quite a few industry-wide surveys in Australia in that space. And a lot of those elements, as you probably would have seen in the previous presentation, are quite key, not just to capital management, but to all elements of the business. There'll be some elements of this presentation that are Australia specific, but we've made it as general as possible, and it does apply no matter what country you're in. So there's some terms there around ICAAP, so the internal capital adequacy assessment process. We will try to just say capital management. Similarly, when we do say APRA, that's really just the regulator wherever you are. So the focus of this session is really firstly around 4 key learnings and groups of thoughts that we have. Secondly, we'll give some very specific stories, examples and anecdotes, and we'll flag that with the icon there. And then thirdly, really what we're trying to get an idea of is where the industry is at and where it's heading. Now, we'll have a poll question pop up about halfway through. If you can complete that by the end of the presentation, that'd be fantastic. If you've got any questions, please post them in the chat. And otherwise, we will move on and I'll pass over to Augustine.
Thanks, James. So yeah, in Australia, APRA introduced formal capital requirements for general and life insurance back in 2013. And that really laid the foundation for how insurers here think about capital today. Then in 2024, fast forward a decade later, recovery plan requirement came in. It's essentially an extension of capital management for crisis situations. ICAAP is your day-to-day framework to ensure adequate capital. Recovery planning kicks in when things get rough. So we've had over a decade of learnings, refinements, and at least 4 rounds of independent reviews. Between James and I, we've reviewed capital management framework and recovery plan for over 15 general insurance across Australia and also Asia Pacific. As James mentioned, we've also run capital management surveys every 3 years since 2014, and last year, our very first recovery plan survey. And these surveys have given us great insight into industry practice, especially helpful since our regulator here, APRA, haven't really released much guidance on capital management recently. So capital management is a mature area, but one that APRA still have a lot of expectations, as they still believe that strong capital management is a cornerstone of good business, especially around board engagements and clear links between risk and capital. So while most of today's insights come from general insurance, which is where our experience really lies, the principle apply across life insurance, health insurance, or banking, and across different jurisdictions. So our 2 most recent surveys, the 2023 ICAAP survey and the 2025 recovery plan survey, cover over 70% of the general insurance market in Australia. They include a broad mix of insurers, direct insurers, reinsurers, monoline, locally incorporated in companies and branches. And that mix matters because capital management isn't a one size fits all. What works for a large incorporated insurer might not be practical for a global reinsurer operating as a local branch here in Australia. We also see different capital targets depending on their access to equity. Insurers with easy access to capital tend to have lower target capital compared to monoline insurers with more limited capital options. So when we talk about best practice, we're always thinking about what's proportional and fit for purpose for each insurer. So the next few slides will look at target capital. There's no universal target capital level. What matters is that it's well justified and consistently applied. From our latest survey, most insurers target somewhere between 1.4 and 1.8 times the minimum capital requirement. A few rarely go above 2 times, and that's typically due to limited capital access or monoline models. So that's why they tend to, target higher capital ratio. And so how are these targets set? Some rely on judgment, looking at reinsurance and access to capital. Others use quantitative models, like from simple stress tests to more complex DFA models. But it's not about how complex it is. It's about how well it reflects the insurer's risk profile and whether stakeholders actually understand it. So we've seen advanced models being used, but that lead to weak governance and poor internal understanding, especially when they're externally maintained. So ICAAP and ORSA are meant to be proportionate. If no one understands the model, there's really no point of using them. So I'm just going to share a few quick stories here that, sort of highlight how target capital levels can play out in practice. One example I had was around one insurer that held around 8 times the minimum capital requirement, which is way above their target ratio of 2 times, with no clear reasons of why they're adopting such high ratio. It might sound like a first world problem, but it signals a lack of discipline. Why is it that some insurers apply rigorous discipline when capital is low, but not when it's high? Excess capital shouldn't mean complacency. A similar but a listed insurer in this case committed to reducing excess capital, but profits over time means that capital continue to accumulate. We suggested that the insurer puts in place trigger points above target level to reinforce accountability. In another case, on the flip side, there was one insurer where the board was comfortable with the capital being 1.17 times the minimum capital requirement, despite the lowest trigger being 1.4 times. Technically, that's allowed, as their capital management plan says that allows for some board's discretion, but it didn't really reflect their risk appetite, and not all board members were comfortable with that. One final example that I'll share is one insurer had no progressive triggers. Either they were in the range or they panicked when capital dipped below target. There's no right or wrong when setting target capital levels, but it's worth asking, are their stakeholders, shareholders truly comfortable with that? So here are some takeaways. Make sure your targets are explainable. And secondly, sophisticated models sometimes, not always, is just a bonus. So the next slide here shows a maturity spectrum, from basic to high, and it's a useful way to reflect on where we sit in terms of how we come up with target capital. On the left, we have subjective judgment, which might be based on gut feel or legacy decisions. Then we move into using industry historical losses, which is a bit more grounded, but still external. Next, we get more tailored with our own historical losses, followed by scenario testing, which starts to bring in that, forward-looking thinking. As we move further to the right, we see single focus models like an internal economic modeling, and finally, the most mature approach, the DFA, dynamic financial analysis. These models are advanced because they integrate multiple risks and give us a more holistic view, both current and also in the future. So I'll leave these sections with a few things for you to reflect on in regards to target capital within your own organization. Can you explain your target capital to someone who wasn't in the room when it was set? Is it reviewed regularly, or is it buried in a document from 10 years ago? And with the rise of new regulatory expectations, whether it's climate risk disclosures, ORSA or ICAAP requirement, financial accountability regime in Australia, which is similar to SMCR in the UK, or CERA in Ireland, operational resilience framework, or CPS 230 as we call it here in Australia, the need for a defensible, explainable basis is more important than ever. So where are you on this scale? So now I'll move on to James, who will talk about emerging risk and scenario testing.
So emerging risks, obviously a very important topic in today's session overall, but when it comes to capital management, also very relevant as it is to many business processes. Part of the capital management survey that we ran asked some of the front of mind emerging risks, with many insurers saying that they did believe they'd have either a moderate impact or some of them even a high or disruptive impact. But given that view and given that front of mindness, it's surprising to see how many still run scenarios on those emerging risks. Now, on one hand, cyber risk has had a lot more data over the recent years. There's a lot more examples to point to when it comes to picking a scenario, deciding what potential impact it might have. But a lot of those other risks, your regulatory change risk, your ESG risks, and particularly if you see at the bottom, the artificial intelligence risk, which no one is running a scenario on. So then are scenarios the answer? Do you either do a scenario or you don't do any analysis? Well, of course not. The key learning from here is to have a robust approach, no matter what that approach is, to considering emerging risks, which we'll get into in a second. Scenarios are useful, but often it's the going beyond just the scenario impact itself that is important. A good example is from both of the capital management and the recovery plan surveys. We looked and asked what the features of the scenarios that they did run had. So the scenarios they ran, did they just look at the impact? Well, some of the main features of the scenarios were the impact, whether it was from a single event, a combination event, an extreme reversed stress test. And of course, that's going to be the common focus. But as we get further down the bottom, we find that the further considerations are actually far fewer included in insurer scenarios. So whether that's around recovery options and actions, the effectiveness or the speed or the expected timeframes for those actions, much fewer include those features. Whether it's the secondary impact, the non-financial considerations, or the barriers to implementing actions, those are also very few and far between. So we tend to find that a lot of insurers sit on that reactive area of the spectrum, but again, it comes down to a maturity scale. So of course you have your basic approach, which is to be passive, react as those events happen. Alternatively, you could do some internal reporting, maintain internal awareness, utilize external reporting. There's plenty of consulting insurance brokers that produce reports for insurers to use. You could run workshops, have experts come in and discuss deep dives of topics. Of course, scenario tests are an option if you have enough data to run them on and you consider them thoroughly, not just the monetary impact. And then, of course, where you can, which is much harder, you can do some modeling. So some thoughts to think on for your emerging risk. Where are you on the scale? Could you do a little bit more, even if it's not quantitative analysis? Is your risk identification done by one team or across multiple teams? And really, are you just focusing on the impact alone? Now, again, some specific anecdotes, which we always find a bit more interesting. We've had a few clients who are much more at the mature end that run workshops with their board at the early stage of updating the scenarios each year. And that really utilizes a good brainstorming from different stakeholders, especially the senior board members that often have exposure to other insurers in the industry. We've also seen one or two that have what we typically refer as a emerging risk forum, which is essentially a working group within the company where people from different teams come together to brainstorm, maintain awareness, produce reporting on emerging risk. So again, doesn't have to be quantitative, it could be something else. Now we might just pause here very briefly. You'll see a poll question pop up at any moment. And really answer this in your own time, but ideally before the end of the presentation. Which of the following challenge areas are you currently seeing affect your organization's risk or capital management? So pick one or more of them, and we'll have a look at that at the very end. Over to you,
Thanks, James. So yeah, our next learning is around board involvement in capital management. And as you see here, it really varies. At one end of the spectrums, you've got boards that are a bit too hands-on, overstepping into management territory, which isn't ideal. Then you've got boards that strike the right balance, that they are well-informed, deeply engaged, and actively challenge assumptions. Next, there are boards that ask questions from time to time, engage, but not consistently. And finally, there are boards that rely heavily on management, essentially rubber stamping decisions without too much scrutiny. This graph here again is from our most recent capital management survey, and it tells an interesting story. Only 1 in 3 boards actively challenge ICAAP. About 1 in 5 rely heavily on management, and while 34% are actively engaged, I'd argue that that number should be higher. But it's not all doom and gloom. During COVID, we saw how adaptable boards can be. Many stepped up, got more involved and made real-time decisions under pressure. So the capacity is there. It's just about sustaining that level of engagement beyond crisis moments. Now, when we look at branches of large global insurance companies or reinsurance companies or entities that rely on capital support from head office, that picture shifts. For many of them, capital management is seen as a compliance exercise, not a strategic one. That's reflected in the 71% of insurers where boards either passively endorse or rely on management, and only 1 in 25 actively challenge capital management. So the challenge is, how do we move from boards that provide passive oversight to ones that offer strategic oversight? Because capital management isn't just about ticking boxes, and the board plays a critical role in setting the right tone for the organization, especially now as regulatory expectations continue to evolve across jurisdictions. That leadership and engagement from the top, has never been more important. So now let's talk about board involvement in recovery planning. When things get tough. Since recovery plans are really an extension of capital management or ORSA, it's not surprising that most of the boards rely on management for the initial design. The capital framework was already set up, so we're not really starting from scratch. What matters more is the annual review. Around half of the boards are actively engaged here, which is encouraging, but I think there's still room to lift that level of challenge and discussion. Where we see a real gap here is in the testing or the simulating of plan activation. Only 22% of the boards are involved, but having said that, in Australia, testing is only required for the larger insurance. But even then, boards are rarely part of it. And that's surprising to me because, in a real crisis, the board would be central to all the decision making. So why not involve them in the simulation? And here's the key takeaway. While boards continue to approve the capital plan and related documents, is often done with minimal scrutiny. There's no real challenge and no deep discussion. In today's environment where many insurers hold excess capital and the boards are more focused on AI, digital transformation, and growth, capital-related discussions like scenario testing can often slip down the agenda. So the board owns the ICAAP, so naturally they should be involved in setting the risk appetite, risk stress testing, and challenging assumptions. But boards have limited time, so it's about striking the right balance, what gets tabled, what gets discussed, and what gets challenged. Setting risk appetite and capital targets, yes, absolutely the boards should be involved, right? It's their appetite after all. And most of the boards that we deal with do this quite well, often through workshops, but when board and management's views don't align, it can be telling, and you'll be surprised by how often this happens. What about stress and scenario testing? Boards shouldn't just be handed results and asked to sign off. But equally, they shouldn't be buried in 20, 25 plus scenarios like what James mentioned earlier. They should only look at the key scenarios. The best boards we've seen engage early, helping choose which scenario to test, usually workshop setting, and then stepping back in towards the end to ask the so what before everything's locked in. What about reviewing and challenging? Absolutely. I think it's their role, the board's role, to review and challenge. But management shouldn't rely on the board to do all the heavy lifting when it comes to reviewing and challenging. Management shouldn't be rolling forward last year's scenarios. Boards should be asking, have you considered X, Y, Z? What if, not just the individual assumptions. One example I want to share is related to an example earlier to do with one insurer holding excess capital. They ran every single scenario you can think of, even the extreme ones, and they still set above the target. That's when the board should have asked, if we're always above the target, what are we doing about it? Should we be adjusting our risk appetite? Should we be revisiting our target level? Should we be investing in growth opportunities? But they didn't, and the chair wasn't comfortable when we interviewed them about how much capital they're holding while the management was. So a few things to think about here for your own organization. Not everything needs deep discussion, but boards should be given the opportunity to engage meaningfully across all areas of ICAAP. Are your boards overwhelmed by too much information? Are they shaping the ICAAP or the ORSA? Or are they just nodding it through? And if they're engaged, are they evidence? So now we're going to James.
No, thanks, Augustine. So now the fourth and last key learning area, which we've colloquially called staying on top of developments. So an exhibit here comes from the ICAAP survey. It's probably our main exhibit that we often use in a lot of our reviews as well. It's essentially a framework across 6 dimensions where insurers are able to self-assess how mature they think they are on each dimension. Now, of course, there's a natural range of maturities, as we've discussed. Some branches may be simple, some multinational, quite multi-line businesses will obviously be much mature. But if you look at that last dimension around embedding tends to be the forgotten child. Embedding tends to be what is often a bit less mature and less focused on. Embedding is much more related to the subject matter and how it's considered in decision-making, how it's referenced as business documents. And the risk with that not being strong enough, not being robust enough, is that of what Augustine essentially mentioned at the beginning, complacency. Not keeping up with new and existing regulatory requirements can often does make life harder later on, even for something like capital management that is a relatively mature aspect. Some quick anecdotes here. We've had many reviews where some of our suggestions are optional. They're left to the insurer to determine to what extent they want to implement it. But we've had some that have either been defensive or dismissive of those. And we've had 2 that have come to us in the last few months and have essentially said they've come back now looking to implement things because they've had pressure from their boards or they've had questions around why they haven't kept up to scratch. So it pays to be on top of things earlier, even for a mature process. So the key learning here, stay on top of developments, keep up with the improvements, and be proactive in addressing new and existing regulation. Now, again, final reminder to answer that poll question if you haven't already. This is our last slide here, and a quick summary of what we've talked about. Now, again, the focus here is on a process, not just for insurers, not just for capital management. It should apply to any risk process. Firstly, have an explainable basis for targets or threshold. Secondly, have a robust approach to considering your emerging risk wherever you are on that scale. Thirdly, have a level of board involvement that's appropriate to the topic, but still enough. And fourthly, stay on top of developments and keep up with improvements. It will make life much easier for future years to come. And with that, we have reached our end, hoping quite on time, and we may pass to Ron and potentially the poll question to see what the results look like.
Yes. Before going into some questions there are, let's first look to the results of the poll.
Yeah, I think it's good. I think there's probably a lot of people that have quite a lot of confidence and don't think they have many issues in their process, which is good. But I think we can see a good amount of respondents there across the different dimensions, particularly around emerging risks, which, let's be honest, is probably the most dynamic area that we constantly need to stay on top of. but also around the balance of risk management and capital management with other strategic initiatives and decisions. I think that's, yeah, always an issue, isn't it? Any comments, Augustine?
No, I think it's not surprising. I'm actually, surprised that no one actually said there are no challenges currently in their organizations, which is, very humbling and very open. So, yeah, that's good to see.
I have a few additional questions to you. You said somewhere, what I picked up, sophisticated models are a bonus. And yes, I understand you were talking about DFA models and all, but I also understood it is very important that what we are doing as risk specialists, you have to explain it clearly to people who are maybe not that involved in techniques. Is that not contradictory, that you want to have something which is quite well to communicate, but what is also very sophisticated?
It's a good
I could
question.
have a go, James.
Go for it, Augie. Yep.
So I think it's an interesting question, because we have seen cases where, not so large, organizations, use a DFA model, but that was externally maintained. It was done by a consultant. They only see the results once a year. When we ask the CFO, when we ask the risk manager, what are the benefits of the DFA? What are some of the risks? What are some of the assumptions? They struggle to answer that question. And I think that's the downside of adopting something that is too complex for their own good. And whilst it's kind of almost like contradictory, you would assume that adopting the most complex is better, but that's not always the case. If you can't communicate that, if you don't have the capacity, if you don't have the resources to be able to explain that to your stakeholders, there's no point in adopting, in my view anyway, there's no point in adopting, complex models. I think as long as you understand the risk, regardless of the approach you choose, I think it's probably better than, having the most complex models. I don't know about you, James.
No, agreed.
Personally, I had also some questions. We are here in a CERA event, so I was thinking that if you see that a board of company is relying heavily on management or on risk management, is that something you think that having that CERA designation helps to give, let's say, a certain feeling also to the board, that they know they rely on professionals which really have the best basis for doing this job?
No, absolutely. I think the CERA qualification and that mindset 100% helps. I think part of it is still being able, as Augustine said, to communicate properly between management and board. We've seen some organizations where the board are very hands-off and they do trust in management, and that's great. Especially, we've seen some very well qualified management with all sorts of qualifications, but there's still that risk there. We've also seen some boards that are probably too much in the detail. We've seen some boards that like having a list of 30 to 50 scenario tests. And when we challenged that and said, this seems a bit much, the management said, no, the board want that. The board want to be that involved in detail. So maybe that's being more in detail, maybe that's less trusting of management, but I think there is that balance, and making sure both the board and management are on the same page is probably most important.
Yeah, great.
Last question I want to ask you, because we are a bit over time, but okay. In the context of a subsidiary insurance company, to what extent should the subsidiary board rely on the promises of capital injections from its parent when setting its local capital risk appetite?
Sorry, I can't hear you, Augustine. Maybe I'll take that one briefly. look, it's a common issue. I think the branches, for example, are always having their one and main and sometimes only action being support from the parent. In practice, that's often true. I think it's the robustness around that. Do they have a guarantee in place? Do they have written evidence of the strength of the parent that they're very unlikely to fall over, so their support is going to be there? Do they have ideas around the timeframes and how the process will work in practice? But I think we still encourage a lot of insurers to think of other actions. And those don't have to be capital actions. They can be risk actions, decisions around business withdrawing from certain products or markets. So there's still opportunities to uplift, even if in practice that is the main and probably only action.
Okay, now thank you very much. I'd like to thank you both. It gives a lot of insights. I have for myself some other questions and some remarks as well, but I will take care that they will reach you as well. I want to thank you, and I wish you a nice evening.